Hey everyone, Chris and Jason here with the Private Lenders Podcast. Thanks for checking us out. If you haven't done so already, please go visit hardmoneymastermind.com. You can create a free account, join the conversation if you're a new or experienced private lender or hard money lender, and let us know what you think. A lot of what we've been addressing on the podcast recently comes directly from questions from the members of the mastermind group. And it's good stuff. It's good stuff, especially earlier on in the game, and then definitely experienced as well. So we're going to go through some stuff today related to how to effectively get your loans funded by investors, like presented to them, the documentation process, or kind of like the closing process, documentation process, assignment, and servicing too. Some of that stuff, there have been some really good questions in the mastermind recently, and we're going to break it down.
Yeah, I feel like we've talked to a lot of people because they can't wrap their brain around the process. And it's not a hard process, and it's a very repeatable process. But I guess after you go through it the first time, then you kind of understand the process between getting funds to the title company, assigning to the capital investors, getting the funds from the capital investors, and then it's just rinse and repeat.
Yeah, totally. I mean, I understand why people have questions because it's just a unique sort of process in real estate. Like in lending or real estate investing, like this stuff right here is just kind of niche. You know, like it doesn't pop up in that many deals, but it does in every one of ours. So, all right, let's break it down. Let's start with when you are communicating with your investors who you've already met, started a relationship with, warmed up, and how you get them into their first deals, their first deal, second deal, third deal, whatever. It definitely gets easier as time goes on, but it's a little more hand-holding, a little more labor intensive for deal number 1 and 2, I'd say. Okay. So during your creating a relationship, pitch process, getting to know somebody and what they want to do, you'll have basic parameters around what people want to fund. I wouldn't say that they can totally pick every aspect of a loan they want to get into, but there are some that they'll be into, like, for example, geographic area. We lend in DC Metro, Baltimore area, and also Philly and Jersey, and also a little bit further west in Pennsylvania. So we have had people over the years, not too many, but a couple people with preferences about maybe they're located around DC, they want to lend around there, right? So something like that could be a parameter that you know going in. Other stuff like loan amounts, like some people want to go in $50K or $100K at a time, and some people have much deeper pockets and they're looking for $500,000 at a time. So certain parameters you'll be putting together, keeping notes on as you're raising capital, meeting people, and getting ready to start funding deals. Okay, so when you have a deal that fits a certain investor's parameter, and hopefully it's not too detailed, like I said, I wouldn't let people like pick and choose all kinds of little things, but if you have a deal, it's pretty much a deal. So you would send them a snapshot, whatever kind of like very short write-up, 5 bullet points, maybe it's on your website, maybe it's on the body of an email, whatever it may be, just to give them a snapshot, a picture of the deal. Here's what it looks like. It's a $250,000 loan amount. It's in Fairfax, Virginia. There's 730 credit, this much for ARV, that, snapshot. Enough for them to say, okay, that makes sense. Get back to me with a full underwriting file, and then we'll discuss it. Or you tell them that. Okay, just want to make sure this is within what we discussed, the kind of stuff you want to lend on. Let us finish the file. You get your valuation in, you get your borrower documents, title work, everything else. And then you send them a full link. We use Google Drive. You can use whatever, Dropbox, whatever you're used to operating with, that has every document and all the details of the transaction. And for the first deal, maybe 2, you're going to want to send it to them, ask them to review, and then you'll get on the phone to go through it. And at that time, you'll walk through all the details. And again, this is really only deal number 1 or 2. After you have a couple successful ones, they're going to get very relaxed about this process. And they're going to be like, okay, yeah, I understand now. I've been through a couple of these before. They worked out well. Deal looks good. Happy to wire the funds. But there is more work to be done on the first couple. Okay. So you're going to walk through the loan file with them, explain to them information about the borrower, the property, the valuation, anything else. It's in all likelihood a pretty straightforward acquisition, or maybe a bridge loan, or maybe a acquisition and rehab loan, and just walk them through it. Here's the deal. Here's the documents that go into a file. Here's why it makes sense. And you're not selling at this point. There's nothing to sell. Like, that's already been throughout the process. If you know, the rest of our capital raising system has already been done subtly. Okay. So an important point about this is that you don't send it out to them and just get their opinion. Do you think this is a good deal? That's not the way it works. You're the lender. This is what you do. You know it's a good deal. Otherwise, it wouldn't even come their way. What you say is, here's the deal. It's, in the parameters we discussed before, and you're welcome to have it. And there really isn't much opportunity for people to say no, because if they say no, then in essence, this is what hard money loans look like. This is what our typical deals look like that we discussed. If this doesn't work for you, then this niche might not work for you. And that's the right response. And at that point, they can be in or out. If it doesn't work for them, you don't force them. It's their money, right? But at the same time, you don't want to let them get in the habit of picking and choosing your deals, of cherry picking your deals. If it comes their way, it is a deal, right? So you need to approach it with that sort of mentality.
Yeah. So they're obviously allowed to ask questions and go through the file. But like you said, if this deal is not going to work for them, the next deal is not going to work for them, right? Because they're all the deals is either a deal or not deal. You can't go through the process of, hey, what do you think about this? What do you think about this? Of course, listen, if someone brings you a deal and you're controlling the transaction, you're going to be like, well, it'd be nice if it was $10,000 lower or I was getting a higher interest rate. Like, it doesn't work like that. And here's the thing. If you're just getting started or you have experience, when you provide them information up front before a live deal, when you're communicating with them up front, and go back through some old videos so you can see this process, but you're going to show them what a sample deal looks like, right? So this deal is going to match up to that sample deal, either a deal you funded in the past or a sample deal of what you look for, right? It's going to be in the 65% or lower LTV, certain credit score, certain cash to close, certain geographic area. So the only thing for the most part that a capital investor can be, have a say in is going to be, do they want to be in a deal by themselves or with other lenders, right? Depending on how much they have, and potentially geographic area. That's a fair statement. And most hard money lenders only lend in one geographic area anyway, so that could be a moot point. We happen to be in, the DC area, where DC, Maryland, and Virginia, DC area to Baltimore area are very different. And then when we opened up our Philadelphia office, we had our DC investors that don't know Philadelphia or don't want to be vested in Philadelphia, as well as our Philadelphia investors that might not want to be vested in the DC market. So that's understandable. But investors don't say no. I mean, Chris sends them over the snapshot and says, hey, here's a deal that was picked for you, hand picked for you, right? Like, this deal's, it meets it and it's cool. That works. Let's proceed. So I think that's important. I've seen some chatter in the mastermind group where people are kind of asking if they think, how to structure it with a capital investor. It's like, listen, you gotta be professional enough and get your ducks in a row and the loan buttoned up first. And again, even if you don't have the capital 100% available right now, that's okay. But you gotta button it up similar to what your metrics is, knowing that any deal that falls in that metric, for the most part, is going to get funded.
Yeah, 100%. I mean, the reality is that people who have capital are typically smart and savvy and successful people. And if you open the door, like, you have to have all your boxes checked, and you have to approach it with confidence and exactly what you're doing. Because if you open the door for them, they're just going to, this sounds a little extreme, but they're going to walk all over you, right? They're going to change your terms. They're going to say you should document this. They're going to say, if you open that door, because that's their personality type. That's why they're successful in the first place, is they can run deals and run companies and businesses. And that's, why they end up having capital. So on the other side of things, they respect the fact that you have your stuff together. When you have everything together and you know exactly how the process goes and how it's underwritten and how it's going to be, they respect that. And that's the way to be.
Yeah.
Okay. Go ahead.
I was just going to say, let's transition between, loan funding, it's ready time to fund a loan.
Okay. Yeah. Let's talk about some of the process and documentation and some of the, moving parts, because I know this is new for a lot of people. All right. So when you have your attorney do loan documents, it's going to be in the name of your company. In our case, it's Hard Money Bankers, LLC. And then we are going to assign it immediately to the investor and say it's ABC LLC, just to make something up, is funding 100% of this $250,000 loan. And the way it works is we have our attorney do the documents. We internally do the assignment because it's a pretty easy form. It doesn't need to be done by a lawyer. Obviously, the template's done by a lawyer, but deal to deal, we can do it. And we'll sign 100% to the investor, to the lender, ABC LLC. And we can show them the assignment. If they're new, here's what's going to be sent to our attorneys. We can have it notarized by someone in our office. And then we do, after funding, send the original document to the attorneys. I'll explain why in a second. Let's talk about the flow of money first. People in the mastermind have definitely asked, so my investor wants to wire directly to the title company. And that's not a good idea. They said that to us at the beginning too. And it just does, it's very inconvenient and it looks a little unprofessional when you don't have control of the timing of your wire. Okay. If somebody, it's, coming from some third party ABC LLC, and you don't know exactly when or what their process is, or if they have to go to the bank, or if it's coming at the end of today or early tomorrow, you don't want to have that lack of control. It doesn't look good to your client or the title company or anybody involved. So, but here's what they say. Here's why they want to do that. A savvy lender investor will know that if they wire their money to you, then there's a little bit of risk there because you could take their money. Very unlikely scenario, one you go to jail for, all of that, but that is in the back of people's minds. So that's why they say I'd prefer to wire directly to a title company. But here's why that doesn't 100% make sense. You're going to be receiving the payoff. You, as the loan servicer, you're going to issue a payoff statement and receive that $250,000 loan payoff in 6 months or whenever it is. That being the case, your investor's money is already going to be in your account at some point. And I said this to one of our people many, many years ago when we made that change early on from wiring to title company to wiring to us. It's like, hey, look, and I kind of made it into a joke. I was like, look, we're going to issue a payoff and get your payoffs, issue a payoff statement, get the payoff funds. If I wanted to steal your money, I could just do it then. He's like, oh, that's a good point. Like, okay. And then ever since then, we never had to discuss any issues about wiring to us because we're already going to be holding the funds at some point.
And keep in mind the process of them, you're in essence, let's say the loan's $100,000. They're giving you $100,000 in exchange for an assignment of the note and mortgage and the whole loan package, for instance. So it's not like they're giving you $100,000. You're assigning them this loan. Mm-hmm. Of
all happening at the same time
of $100,000. Yeah. So it's happening simultaneously. So that's where they're in essence buying the, they're the lender, right?
Yeah.
They're
buying
lender.
A note from you, like however you want to,
however you want
to look at it.
Yeah. However you want to justify it. Exactly.
Let's talk about public record real quick and the recording of assignments or the lack thereof, because that's a common question too, and a good one, and one that we know from experience how to do it. Okay. So you could put your lender's name on the note and on the deed of trust or mortgage, depending on the state, if you wanted to. We don't think it's a good idea for a couple of reasons. One, it doesn't look terribly professional, especially if you have a fractionalized note. And I remember we borrowed one time, way back in the day before we started HMB, and we saw on the note and the mortgage all of these investors, which are like random personal names, like Sharon Smith and stuff like that, for like 15%, 20%, equaling 100% because it was a fractionalized note. It didn't look great. And we didn't do that for long at HMB, less than a year probably, for a couple of reasons. Like one, just the look and feel of it is not terribly professional. And also we learned from experience that you don't want to put your lenders' names in public record, because if something goes down in foreclosure or litigation or something like that, they could get brought into the litigation with you. And that happened to us. We had this guy dragged into court in DC Superior Court. It was a mess. It was really early on in our company because his name was there as a lender. And we got into litigation and we won. Everything was fine. But the poor guy was dragged into court for like 2 or 3 hearings or something like that. It was a mess. And he never came back for another loan because of that experience. Had we kept his name out of public record, I guarantee that guy would still be with us today.
Yeah, because the loan was paid off and everyone was made whole. It just happened that he was brought into litigation with us. Not suing us, obviously the borrower was through our bankruptcy process. Keep in mind when you file all of those, anything that's public record, think about anything that's public record. I mean, we get legal notices regularly in our office, right? Between, the recordings to bankruptcy filings, to foreclosure filings, to, I mean, there's times that somebody will file bankruptcy 10 years, a bankruptcy 10 years from now, and we're an ex-creditor and they're going to reach out to us on stuff. So, and that's okay. You know, we're a built-in lending company. We're a full service company and a servicer, so we can handle that. But, you know, you don't want like an 80-year-old passive investor to, you know, to be served court documents, you know, on a weekend from a process server. Like that happens sometimes. And, you know, again, as you do more deals and as there's more things that come up, like that stuff happens. If you're, you know, this isn't a default show, but you know, if you're foreclosing on somebody, that bar knows they're getting foreclosed on, like they're gonna sometimes fight to try to, you know, retain ownership of that. And keep in mind, you know, anyone can file a lawsuit just to file a lawsuit, right? You know, you could personally file bankruptcy yourself and not even, you know, you don't need an attorney to do that. So you don't think that
bankruptcy, list pendants, people can throw out all kinds of stuff.
Yeah, you don't think that the day before foreclosure, somebody doesn't want to lose a property, they're just going to file a bankruptcy themselves just to kill time, so we have to re-auction it. You know, things like that happen, right? The point is you don't want to get your capital investors being public record. Yeah,
and so here's how we solve both of those. Best of both worlds. So we learned early on. I've been doing it the same way ever since. Okay, so like we said, we want to keep them out of public record, but at the same time, they want their investment to be protected, right? So if HMB disappears, in the super unlikely event that HMB disappears for some reason, they need to be able to take control of their liens, their outstanding loans on properties. So in order to solve this, we take that assignment document that's assigning 100% of this loan to ABC LLC, the lender, sign it, notarize it in our office, mail it a couple times a month, like whatever we've closed, to our attorneys. And all of our investors know that if they ever need to get a hold of an assignment, they can go get the original from our attorneys. They have all their contact info that's laid out. No one's ever needed it. Hopefully no one ever will. But that's how we do both. That's how we protect against both. We keep their name, protect their anonymity and their privacy, and keep their name out of public record. But at the same time, their investment is protected by being able to take control of the lien in the very likely event that they would need to.
Yeah, I mean, that's how our investors. Yeah, that's how our investors want it. And I think we covered a good. You know, I think the hardest part is this transition between, okay, it's the day of closing. How do I get my investors' money? How do I get them this assignment? You know, chicken and egg. Do I have to give them the assignment before they send me the money? Things like that. And this is a trust business, right? So it's got to be done, you know, kind of the right way. I mean, these capital investors aren't people that you met yesterday and they're funding $100,000 deal today. You know, it's usually a 30+ day process for the relationship that you're building with them. You know, and that's why, you know, everyone we do private consulting with, we're like, hey, listen, you got to make sure, you know, you're doing investor meetings on a regular basis, because, you know, when you need the money, you got to make sure you planted that seed a while back, because it's not happening today. You know, you're not going to raise. In 2 days. Yeah, it's usually, and our whole raising capital process takes over 30 days, 45 days before they're even allowed to get into the first deal. So, yeah, I mean, it's, you know, again, like this is stuff that we do on a regular basis, so it's kind of like easy for us to think through. So I've been trying to, you know, figure out good ways to communicate this and dumb this down to real, like, this is the steps. This is the way that it works. Because it's not hard, right? It's not challenging to do, but at the same time, you do got to make sure you have a good relationship with your capital investor, because on both sides. And that's, you know, the important part. And like Chris said earlier on, you know, after you do this, the first deal or the second deal, it just gets easier and easier and easier, because after, you know, the first or second deal, that money might just be coming right back to you as the servicer, and then you have it liquid to put into the next deal with their permission. Yeah, it gets way easier. Doesn't have to go back to them back and forth and back and forth and back and forth. Yeah, which is their preference. But yeah. Like Jason reiterated, this is a first deal, maybe second deal kind of problem. And it's not even a problem. It's just a process to go through. And then after that, everybody gets it. They know how it flows, and you just crank them out. Cool. Anything else to add before we wrap up? I think that covers pretty well what people are asking about in the mastermind. No, I think that's it. I certainly appreciate everybody who is listening to this. and watching this, if you could do us a quick favor, if you're listening to this through our podcast, if you enjoyed what you heard, feel free to give us a 5-star review, maybe even a comment. We'd certainly appreciate that. The joke that Chris and I always talk about is we're not talking about hard money lending publicly. We're just talking it behind closed doors to ourselves. And it's something we enjoy talking about, and, happy to spread our knowledge to anyone who's interested. So if you could like, share, comment, we'd really appreciate it. Make sure to check out hardmoneymastermind.com. We already have, well over 100 private and hard money lenders throughout the country on the platform, and completely free. Come and check it out. You'll enjoy it.